Morning everybody, Dwayne Trevor there, DRFX Trading. Today I'm going to take a look at the situation on the pound Japanese yen pair. Here we see that the pair has actually been in a very strong uptrend since middle of 2012. During this time it has formed an outer uptrend line as well as an inner uptrend line, as well as these two large pennant consolidation formations. This first one was broken in 2014 in October, shortly after which it pulled back to then form this second consolidation boundary at the inner uptrend line. Now, zooming in, we can take a look at what the situation has been with regards to this second consolidation. Here we see that the resistance boundary of this setup has actually been broken bullish. Here we see that the market actually rallied, broke the barrier initially, pulled back, formed this counter trend line, and then U-turn to produce this second bullish candle to actually start the breakout that is now taking place. This setup is something that you would have seen across all time frames in this currency market with regards to consolidation breakouts. This setup and the signal provided is actually one of three ways in which the consolidations can be broken. Here we see that these are the three options that you have in terms of consolidation breakouts. The first is that the market can actually continue its breakout with this signal to start the overall movement beyond the consolidation boundary. In the second way, the market can come to the boundary, pull back, and then U-turn to provide that signal that leads to the breakout. And the third way, which is what is actually taking place on the pound yen, is that the market breaks the barrier initially, pulls back to test that boundary, and then U-turns to provide that signal that actually leads to the breakout. So this is what is taking place. The bullish signal that was provided was a very attractive one, was a very, under normal circumstances, this is the size of the candle that you would normally want to trade with regards to breakouts from consolidation. However, the problem with this is that in terms of trading it, it would have been a little difficult. Here we see that the stop loss required to have traded that signal when it closed would have been close to 400 pips from 188, facing a stop loss below this area here, which would have been the safest area, 188.80 thereabouts. The market actually did provide somewhat of a pullback, but it still would have been too large for most retail traders to have used as a stop loss. Even in this second option here, when the market provided another U-turn, entry at about 185.83 would have required a stop loss of over 100, close to 160 pips. So this again would not have been a possible trade for us to take at this area here. Perhaps as we move along, there might be another option for us to trade, which may provide a smaller stop loss. But so far, the market seems to be providing signals that are very large and too large for most retail traders to be able to use to trade, to take advantage of this breakout. So this is the situation unfolding on the pound yen at this time. A nice breakout signal from the consolidation has taken place, but unfortunately, the stop loss required to trade this on the 4-hour chart is too large. So this is one of the situations in which we just have to hope that another situation presents itself for us to trade on this pair, or simply move on to another pair that will provide a better stop loss that is more in keeping with the risk requirements or capital management requirements that we would have to trade these types of breakouts. So until then, take care.